Hello, this is Anton Bayer and Matt Marmestein, and we've got episode number 56 on Daybreak with Anton. And today we're going to be reviewing this weekly brief titled Slowing But Growing. And we're going to review actually a number of economic reports. Usually we review one or two, but today we're going to be reviewing several. And that way we can kind of get a bigger picture, kind of paint the scenario of where the economy is from different perspectives, and most importantly, what that may mean to the stock market and the second half of this year. So, Matt, you and I were talking about the first report, which is the Institutional Supply Management Report, the ISM report, and you were making some observations.
Yeah. It's an interesting report. It's basically an index that calculates 5 of the 11 components of purchasing managers. That about 300 manufacturing companies nationwide. Right. And we use it as kind of an indicator of economic activity. So as the managers adjust their budgets and decide what they're going to purchase and forecast their orders, we can kind of track, supply and demand essentially. So
exactly.
When we're looking at this graph, which you can see on our website, upcapitalmgmt.com, index reading of 50 or higher tells us that the sector is growing. And if it's below 50, we know that it's contracting or slowing. And in 2019, we hit a little bit of a slowing cycle because we had 3 years of tremendous growth. And then of course, what do we have? Well, we had the coronavirus pandemic, and that actually crushed it because production was completely shut down. No one knew when they'd go back to work, and no one knew what was going to happen. Of course, that the supply and demand shot up, which was kind of funny. People didn't realize that, wow, we have nothing. Once it was available again, let's go buy.
What was interesting is
it was going to be a wild swing, and they basically restarted the manufacturing mid 2020, and it shot up to its highest reading ever since I think it was 85. So then for the month of March, the index continued its decline. For the month of March, the index continues to decline since June 2022. That was of this year, and we had the lowest reading, 46.3, and that was since May of 2020. And the index dropped below 50 in 2022 as well, which was much lower than the past 10 years. So we can kind of follow this trend, but the good news, it's not necessarily a bad thing. And the reason we know this is if we go back, we have data sets, again, upcapitalmgmt.com, look at the graph there, all the way back to 1945, manufacturing moves in cycles. We have peaks and valleys of production, all based on supply and demand, right?
And pretty quick cycles. When it peaks, it's usually for a month or two, and when it bottoms, it's usually for a month or two. And then shortly after that, it's either on a decline from the peak or on a rise from the bottom. And so it's not long U-shaped cycles. They're V's and W's.
Right. Yeah, I mean, really, you never want an oversupply whenever you're selling products, right? That'll just kill demand. So, of course, people need to take pauses once in a while and let any excess supply get eaten up. It makes sense.
Absolutely. And then you know what the buffer is, as the supply managers are putting their orders or slowing down their orders, in this fairly robust cycles of peak and valleys. You know what the buffer is that keeps the economy smooth and steady?
What's that?
Inventory.
Right.
So as inventories are the buffer, so that companies, their sales and revenues don't cycle this sharp up and down, and the inventory cycle through as the purchasing managers are trying to, at best as they can, manage their inventories, manage their purchases. And the challenge with some industries is some products don't have long shelf life. And so, they have to, be much closer to that. For example, food industries or products that either cannot sustain on the shelves or their technology gets outdated within a year. So it's a challenging job being a supply purchasing manager and managing inventories. Salespeople are all wild and crazy guys and gals and all ready to buy, talk very optimistically. But
Right.
it's the supply managers that are sort of the core of a company not buying too much, or then not buying enough and being short.
Yeah, keeping that balance, right? Yeah.
Right. Yeah. Yeah. So that's we're going to go back to many times Jerome Powell, who has been very clear with his goals and what the objective of the rate hike policy they started last March, and that is a more sustainable, stable, moderate growing economy. And from the hyper growth that we had early last year, the prognosis was we're heading into a big collapse. And if the Feds really bump rates beyond what the analysts had, said that they should, and they did, the analysts were wrong. We are not in a collapse. We're in second quarter, and really no indication of a recession or worse, at least brewing right now. And the stock market and institutional managers and portfolio managers are buying. So,
Right.
So that's so far, the slowing is good because that's what needs to be done. You don't want to be in a hyperinflation, but at a pace that seems to be sustainable and moderate.
Right. Yeah.
What's the next report?
We also took a look at, of course, the JOLTS report, the job opening and labor turnover. And it actually, job openings fell by 632,000 to 9.9 million. This was in February. And this is the lowest it's been since May of 2021. However, there's still an all-time high of job openings. So we had professional business services lost about 278,000. Healthcare social assistance was down 150. Transportation, warehouse, utilities down 145. But interestingly, construction, of course, we all know construction, we need more and more of them, up 129,000. And entertainment, recreation, up a small, but 38,000. So still up.
That's, it's interesting, Matt, that is only 38,000 going into the spring and summer. When you think hospitality and entertainment would be, ramping up for a summer, but that might change next month. But it is interesting that wasn't a little bit more. Yeah.
Well, another interesting thing was that the people quitting their jobs was still super high. So in March, 146,000 people quit their jobs just from a month earlier, and layoffs and discharges actually decreased. So another interesting little tidbit of info on the jobs report, which is interesting because Jerome Powell has said that his goal is basically to raise unemployment, which we both it's a funny indicator, a funny choice, but of course he has to try to slow the economy.
Right.
And we were both had some interesting thoughts on that. I like what you were telling me earlier. If you want to talk about that a little.
Yeah, it is. It's an interesting thing, Matt, that you're just not hearing or reading about at all. But Jerome Powell's been very consistent. Everybody focuses on his inflation target, which is a 2% annual growth. But no one's really talking about the other goals that the Federal Open Market Committee also has, and that is higher unemployment. Their target is 4.5% to 5% unemployment from the current 3.7%. And somehow in their economic matrix, they have determined that we have too many people working. And there is some logic to their objectives, in which you have too few workers for too many jobs, so employers have to keep bumping their wages or starting opening salaries to be able to entice people to come to work or move from one company to another. And so with rising wages, that gets passed on into prices eventually to the consumer.
Right.
So just like we've all experienced sticker shock at the restaurant, it's like, oh my gosh, I just wanted a sandwich. It's passing on to us as wages keep going up. So even though wages have peaked since middle of last year and have been declining since middle of last year, not nearly fast enough, but it will help with inflation and the Fed's target to see inflation slow down. But so long as we have, what does it, Matt, say, 9.9 million job openings right now? Is that the right number?
Correct.
Yep. Yeah. It's, that's still the highest in history by almost 50%. So that's going to be a factor. None of us like to see anybody wanting to work out of a job, and clearly that probably is not the case now with so many job openings. But there needs to be some balance in here. We either have suddenly way too many people that have come into America that are eligible for a job, or a lot of people that formerly were eligible are not working. But it seems crazy, Matt, that 9.9 million job openings. So that's a big number.
Yeah, but, I think with a high level of people quitting their jobs too, that most likely is indicating that they're getting higher, better paying jobs or better benefits, things like that. So a lot of turnover and quitting means that there's still a ton of opportunity.
Yeah, absolutely. Yeah. So let's wrap it up, Matt. What does this mean to me as the reader, listener? So we talk about the stock market and how all of these indicators give us some idea of what the future looks like. So as we close out the first quarter, all the three major indices, the S&P, the NASDAQ, and Dow, all ended positively. NASDAQ led the first quarter with a nice bounce back. I believe it was 16%. Is that right, Matt?
Yeah, 16.77, almost 17.
Yeah.
Awesome.
Yeah. So that's a nice bounce back, but it was down 33% last year. So it's less than halfway recovery from last year, but that's okay. We would like to get away from the big swings in the market. S&P was up 7% and Dow Jones 1.8%. So that's good. And the indications from many of the economic indicators that we've been covering most of this year all remain safely in a positive mode. And more importantly, all three indices have recovered from their October low of last year and have maintained a positive trend where when it sells off like it did in February, it doesn't sell off below the previous low. And when it rallies above the previous high. So that trend is clearly in place. So that's good. And the reason I say it's good is because the market and the indices are all reflective of what institutional managers are doing with their portfolios, managing billions of dollars for their investors. And if they foresee that whatever they're buying today is probably going to be at a better price down the road, that's good. And when they see the opposite, they're selling. And, so that trend at this point still remains in place. So that's good technically. And then fundamentally on the reports that we've covered today would also indicate, a sustainable positive economy. So at this point, we remain very favorable in our portfolios. We have been taking advantage of the higher interest rates, adding CDs to our fixed income side of all our portfolios. We have a fixed income portfolio that's just CDs, and we've been able to average 4.5 to 4.7% returns. Yesterday did some buying at 5%, 6-month CDs. So higher interest rates are giving us some really good opportunities to fill in the income side with a lot more security and decent dividend yield than bonds would have been offering. Yeah.
Some of the first times in my life that opportunity has been there. So pretty interesting. Yeah.
No, it's makes the income side a lot easier because bond yields are still below 2%. The 30-year Treasury, 20-year Treasury last year dropped 33% last year. So, the volatility in the bond market will continue to be severe with rising interest rates. Bonds go down when interest rates go up, and that's something that we're facing. But it's created a whole new marketplace, asset class that's usable that we've not had, and like you said, never had in your lifetime, is good dividend yields from CDs and fixed income instruments.
Yeah, pretty cool. Well, thank you very much, Anton.
Yep, I had to call in, and I'm glad you were able to lead this one here, Matt. And I look forward to talking to everybody. If anyone has any questions about this podcast or would like to get in touch with us, You can reach us at upcapitalmgmt.com. Love to talk to you. Talk to you later.
Have a great day.
All right.